When the stock market started falling in 2000, and when the stock market started falling in 2008, and when the stock market started falling in 1973, it was very calm and collective, nothing too big, just kind of a general downturn, no trauma, no drama, 10% down, 15% down, 20% down, 25% down, and then it starts to accelerate. So we've got to look at what happened before those. And the thing that happened before those is something called a inversion in yield curve. Yes, we're going to talk about the yield curve today. We're going to talk about how it is affecting more negatively to the bond market than even the stock market, and how that's absolutely crushing people's retirements. But it doesn't have to be that way. Stick around, we're going to cover that and so much more. Hey everybody, this is RC Peck with Fearless Wealth, and this is my weekly video. I pour through thousands of price charts, look at a lot of data, and come up with what I believe might be one of the more important things going on. And the thing I'm going to look at is typically not the thing that everyone else is looking at. Otherwise, what's the point? Okay, so I want to look at yield curves today. Woohoo! Very exciting yield curves. And I want to look at the bond market. There was one bond that was holding out, that was holding the entire bond market together. And it finally cracked and is now absolutely falling with the rest of the bond market. So let's jump over to zip price charts. The first thing I want to look at here is, we're going back to 2000 here. So look at the screen here. There's two charts, a top chart and a bottom chart. The top chart is the yield curve. So the yield curve is when you take the yield on the 10-year treasury and you subtract the yield on the 2-year treasury. That equation should always come out to be something positive, right? Because you will want to be paid more if you give the government your money for 10 years rather than 2 years. So the yield on a 10-year should always be more than the yield on a 2-year, except when it's not, when things get really dangerous and unstable, which is what was happening in the year 2000. The bottom price chart is the S&P 500. So if you look at the bottom chart, and I see my video is a little bit in the way there. Let me just get that out of the way. There, I think that helps. The bottom chart is the S&P 500. What I want you to see here, the thing I want to point out here is back in 2000, the yield curve went inverted, or it inverted. And notice that the yield curve was inverted. It started, call it February 1st, but the stock market didn't start really falling for another seven or 8 months, where the red vertical line is. And then the S&P fell 50%, 50, fell 50%. Notice the yield curve then turned positive, right? So the yield curve went negative, stock market stopped going up, and the yield curve turned positive, or it steepened, if you really want to know the term. And while the yield curve steepened, the market continued to fall for 30 months. And so a lot of people just don't know the history of the yield curve and market tops. But back in 2000, it inverted for a full, 8 months before the market topped out. And then the S&P 500, other markets fell much harder, but the S&P 500 via SPY fell 50%. Okay, now let's just pop over to 2008. The yield curve inverted the previous, we can almost call it 18 months. 2006, it inverted. It was inverted in 2007, and then it started to steepen, so it got uninverted. It got back to healthiness, and then the stock market started falling. So after the curve inverted, stayed inverted for just easy math, let's call it a year-ish, then the yield curve started to steepen again. Then the stock market fell 50, I'm going from memory here, 58%, 55, 58% in the global financial crisis. So it preceded it, but the stock market started falling after it steepened. Now you go to today. Now look at this. This is really interesting. Again, we're looking at the same information, but a different time frame. So the top price chart is the yield curve, and it inverted in July. For easy math, just call it July 1st. Okay, but the stock market was already down at that point 20%. It started falling before the yield curve inverted. And this inversion is pretty steep. So this is where I think we are. I think at a minimum, it looks like the stock market's going to continue to fall as long as the yield curve stays inverted. Now, every time is slightly different, right? Because we looked at 2000, we looked at 2008, and this is 2022. So each time they're slightly different. What is similar is an inverted yield curve means unhealthy, means instability, means not good, which means stocks are weak, stocks are going lower. Now, I have best case scenario on the stock market fall that the S&P goes to its pre-COVID high. That means the S&P is going to fall probably somewhere between 33 and 35%. We're down about 21% today. So that's where I see the best case scenario. The thing is, though, people aren't getting as crazy worried about the stock market yet. Literally, volatility hasn't even spiked yet. It's been very calm. Yeah, the market just kind of low and slowly falling. And you can kind of see that in this price chart here. It's just a super calm falling of the price charts, right, of SPY. Nothing crazy here. The craziness is happening over in bonds. So look at this. This is IEF. So this is IEF, which is an ETF that holds U.S. Treasury bonds between 7 and 10 years. Okay. Now, this is the beginning of the year right there where my blue vertical lines are. Just from the beginning of the year, IEF is down about, now I got to put my glasses on, 15% for the year. Now, to put this in perspective, the S&P is down just about 21% for the year. It gets even worse. TLT, which are 20-year treasuries, if we look at where they started at the beginning of the year, they're down 29%. This is where the real trauma is happening in the investment world. It's actually the pain and the violence and the volatility is happening within people's bond portfolios. And this is true pain because most people were taught by their big box advisor in the industry that bond means safe, bond means protected, bond means my money will be there. That is not true for this recession. And whether we're in a recession right now, have been for a month, or will be in 3 months, the market is weak, the market is falling, and it is starting to accelerate in that downward trend. Now, I talked about one bond that was really kind of holding up, and it was the short duration or the shorter term inflation protected treasuries. And it just recently broke down really with a vengeance. A vengeance, if you can see here on the chart, if you're watching this on video and not just listening to it, finally STIP broke down. It was really holding up. Now, this is showing this bond with dividends reinvested. So if I just showed it to you just from a price point of view, it would look even worse. But this was the one bond that kind of like the holdout bond that was kind of, in my world, holding everything together. But bonds are really taking it on the chin now. To ask where it's going to end, I think it ends when the yield on the 10-year treasury is maybe at 4.5%, which is just going to create so much more pain for the bond market. And it's a place that you really, really, really either be very careful if you're in it or just stay away from it completely. Okay, so let's talk about what's going on right now. We are taught, especially over the last few years, that markets just fall really fast and then they fall and they get done falling and then they go back up. That was a different era, right? That was an era of zero interest rate policy by the Fed, disinflation, really cheap labor. Actually, I wrote a bunch of this down. Really cheap labor. cheap supply chain, right? Think about all this stuff pre-2020. Inflation about 2%, not 4 or 5%. You could always get cheap oil. You could get a stable supply of energy. All of these things are changed and have changed, especially the cheap labor thing, especially the stable energy getting imported. Those are all different now. And there's a huge problem going on the planet, and it's called Russia. It is absolutely imploding, and it's going to take Europe with it, right? Russia's big. It's 144 million people. From a landmass point of view, it's the largest country on the planet. It's 11 time zones, right? They started a land war in Europe. They're basically now making people go into the army. This is not good. They can't even train the people they have, let alone the 300,000 they said they're going to bring in. So things are getting worse in Europe, which means they're getting worse for energy, which means they're kind of getting worse for everything. But still, the market hasn't really fleshed itself out. It's still just digesting all this information slowly, calmly. People have not panicked yet. Yes, people are going into the US dollar, but it's because it's the last safe investment out there. US bonds aren't safe. Japanese bonds aren't safe. Japanese yen isn't safe. Literally, it's just the US dollar today. That's why everyone's panicking into it. But yet people have yet to panic out of the stock market. So wrapping it up, things are going to continue to get more unstable. Very 2008, very 2000, very 1974. You have to have a strategy that cares about the market direction and not so much just your age, the year you were born, and how you answer those 7 questions on that Tuesday so long ago. There's absolutely a better way. Let me know where you think I got it right, where I got it wrong. I always appreciate you all leaving your comments. If you're curious about a different way, I believe a better way, a way that is agnostic to the market, that is not a long only way, please reach out to us. It's super simple. The next step is always the easiest. You can just literally email us at hello@fearlesswealth.com and say interested, or you can say portfolio review. Thanks everyone for being in my world. I appreciate you. I appreciate you watching the videos. I appreciate you sharing them. Have yourself a great weekend. If in fact you are watching this on the weekend, if not, just have yourself a great day. Okay, bye.